wouldn't be a Sunday night if the Federal Reserve and the government wasn't out there trying to find another buyer for yet another failed bank. I think they've been doing this all day. They're trying to find buyers for the bank, and they have several big banks that have stepped up. Of course, they want to cherry pick the assets, right? They don't want any of the problems. They just want all the good stuff, and they want to buy that on the cheap. And you don't blame them, but obviously the big banks are going to get bigger as they're buying up First Republic, which is a regional bank, but it's still a decent sized bank. They got a lot of branches throughout the country, or actually, I'm not really sure, what states they're in, but I read that they had 82 branches is how many they have. And I talked about the bank again on my last podcast, which I did on Wednesday. And on that day, the shares were down about 30% or 40%. And I pointed out that they were down now 97% from the 52-week high. But I also mentioned how dangerous it was to buy it, because if it fell that last 3%, doesn't seem like a lot, right? Hey, it's already down 97%. What's another 3%? Well, if you buy it down 97% and it goes down another 3%, you lose 100%, which is probably what's going to happen to the people who bought it. Now, in fact, on Friday, before the news that the bank was going into receivership, it dropped another 43% on Friday. And we'll see when it opens tomorrow where it's going to be. I mean, it probably won't be at zero, but it will be below $1, right? It'll pennies a share on the stock. But meanwhile, they're trying to find buyers right now. And remember, I talked about the initial rescue plan for this bank, because the first thing that happened is you had a bunch of major banks put up money, I think $30 billion in total new deposits to save the bank. Why? Well, because everybody else was taking their money out. And I mentioned at the time that these big banks were probably getting that money from the Fed. They were probably taking their underwater treasuries, long-term treasuries, mortgage-backed securities. They were giving them to the Fed. And then they were taking that cash and depositing it over at First Republic Bank, where they can earn a higher yield, I guess, than, I don't know. But that was also propping us First Republic Bank. But that wasn't enough, because a lot of other money got sucked out because people are worried, right? They run on the bank. None of these banks can handle a run. Thanks to the Federal Reserve, thanks to the FDIC with the deposit insurance, the minute anybody does get scared about the bank is finished. It's going to fail, because none of these banks keep adequate reserves in case of a run, because they all assume there won't be one, because that's what the FDIC is for, to make sure there's no runs, because the public knows, hey, my money is safe because it's got the FDIC. Well, it's not necessarily safe, so why take a chance? Yank your money out. And then the other thing is that rates have moved up a lot. First Republic is in no position to pay a competitive rate, can't afford it. Why? It buried all of its money in long-term low-yielding treasuries and mortgages, so it doesn't have the money. And so the entire banking system is a house of cards, thanks to the U.S. government. And now that house of cards is collapsing one card at a time. But more are going to happen. A lot more banks. This is not the end of it. We're still early days in the 2023 financial crisis. And that's exactly what this is. Again, the media is reluctant to call this a financial crisis. Well, what is it? Banks keep failing. Aren't banks financial institutions? But no, they don't want to do it because they don't want to invoke the memory of 2008. They don't want anyone to think that what we're experiencing is another 2008. Now, in a way, they're right, because it's not another 2008. It's going to be way worse than 2008, but it is a financial crisis. And again, it's not just banks, right? The Fed screwed up everything that is a function of interest rates, right? Anything that is rate sensitive is all screwed up because rates were so low for so long. So it's not just the banking system, although the banks are, right at the forefront of this. But you've got the automobile industry. How were people buying cars? Well, with loans. Well, the loans that were really low because of the interest rates. So the whole automotive market was propped up by cheap money. Well, that's collapsing. And of course, that's also got the banks involved because the banks are holding on to the paper, right? They're the ones that loaned out the money so people could overpay for cars that they couldn't afford. Housing, of course, everybody is buying homes with a mortgage. So the whole housing market, was dysfunctional rather, based on the Fed. The Fed screwed up the housing market. And one of the other areas that the Fed really screwed up was the government spending. How was it that the federal government was able to run these enormous deficits, right? We're having this big, debate now about the debt ceiling. The debt is 31.7 trillion, right? It's even above the ceiling because the ceiling was 31.5, and somehow we're already a couple $100 billion above the ceiling that hasn't even been raised yet. And they're doing sleight of hand with the budget. It's probably a lot bigger number now because they're cooking the books to try to keep the debt down until they officially raise the ceiling. And the Republicans only proposed raising it by $1.5 trillion, which is nothing given the rate at which we're racking up debt. But how was it that we could run these huge deficits? How are we able to sustain a $31.7 trillion national debt? It's because interest rates were so low. If the Federal Reserve had not kept interest rates at zero for so long, had interest rates reflected the appropriate price of money that a free market would set, there is no way the government could have gotten away with this. Government could not be this big. Government could not have spent all this money because it couldn't have afforded to pay the interest on the debt. So the only reason that government got so big, that spending got so, they were spending so much and the deficits got so large was because the Fed had rates down. Now, when the Fed lets rates go back up, everything that was built on a foundation of 0% crashes, including the government. The government is going to come crashing down if the Fed holds the line on fighting inflation because the government can't survive. We can't have these deficits and normal interest rates and fight inflation. So the government is going to be forced to downsize dramatically, make big cuts in government spending if the Fed is going to continue to fight inflation and keep rates up, which I don't think it's going to do because the Fed is going to choose to reverse course to stop banks from failing, to stop the auto industry from imploding, the housing industry, the government from slashing government spending. Even corporate America is all levered up.